Hello friends, and welcome to Webronaq. Here is a question worth thinking about. You have probably heard the term IPO thrown around in the news, maybe when a big tech startup finally hits the stock market, or when a brand you use every day suddenly becomes a publicly traded company. But what does it actually mean, and why should you care about it? Whether you are just starting to learn about investing, or simply want to understand how money and business really work, knowing what an IPO is gives you a clearer picture of how companies grow, and how wealth is created. In this video, we are going to break it all down in plain language, step by step. Next, let us start with the very basics and define exactly what an IPO is. Alright, so what exactly is an IPO? IPO stands for Initial Public Offering. It is the very first time a private company sells shares of itself to the general public. Before an IPO, a company is privately owned, meaning only a small group of people, usually the founders, early employees, and venture capital investors, hold any stake in it. After an IPO, the company lists its shares on a public stock exchange like the NYSE or NASDAQ. Now anyone, including everyday investors like you, can buy a piece of that business. Think of it as the company opening its doors to the public for the very first time and saying, here is a chance to own a slice of what we have built. Next, let us look at why companies actually choose to do this. Now look at this. Companies do not go public by accident. There are three clear reasons behind almost every IPO. First and most obvious, raising capital. Going public lets a company bring in enormous amounts of money to fund growth, hire people, invest in research, or even pay down debt. Second, giving early investors a way out. Venture capital firms and founders often have their wealth locked up in the company for years. An IPO is their chance to finally convert that stake into real cash. This is called a liquidity event. Third, credibility and brand visibility. A publicly listed company carries a level of transparency and trust that private companies simply do not have. It signals to the world that the business is serious. So the motivations are financial, personal, and strategic all at once. Up next, let us walk through exactly how the process works. Here is how it actually works. The process typically takes anywhere from 6 months to 2 years. It starts when a company hires underwriters, usually major investment banks, who guide the entire offering. Next, the company files a registration statement with the SEC, which is the government body that regulates U.S. markets. This filing makes the company's financials public for the first time. Then comes the roadshow, where executives travel and pitch the company to large institutional investors like pension funds and asset managers. Based on the interest generated, the underwriters and the company set a final share price. And on listing day, the stock begins trading on a public exchange and anyone with a brokerage account can buy in. Every step matters, and every step carries risk. That brings us to a real-world example that shows both sides of the story. Let me show you both sides with real numbers. In February 2025, defense company Karman Holdings, ticker KRMN, went public on the NYSE at $22 per share. By the end of that year, shares had climbed to above $73, a gain of over 230%. That is the kind of headline-grabbing result that makes IPOs exciting. But here is the important part. In 2025, over 200 companies went public on U.S. exchanges, and fewer than 1 in 4 of those IPOs managed to beat the S&P 500, which itself returned 18% that year. So while the upside can be extraordinary, the average outcome is much more modest. IPO investing is not a guaranteed win. Hype and momentum on day one do not always translate to long-term value. Keep that in mind as we pull everything together in our final slide. Alright, let us pull everything together. An IPO is simply a company opening its doors to public investors for the first time, selling shares to raise capital, and giving everyday people a chance at ownership. We covered how companies set their valuation, how underwriters price and market the deal, and how the lockup period can affect what happens after trading begins. We also looked at real numbers. KRMN showed what the upside can look like. But across 2025, most IPOs as a group trailed the S&P 500. The excitement is real, but so is the risk. The key takeaway is this. An IPO is an opportunity, not a guarantee. Before you invest in any new listing, understand the business, read the prospectus, and weigh the risks against your own goals. As always, speaking with a financial professional is a smart move. Thanks for watching, and we will see you in the next one.